today.
No, there's no debt on the agenda other than the TAN that was completed, so they all said they'll wait till the December meeting, and
Okay,
that's
well, let's
fine.
welcome each other then. You want to start over here?
Start that.
Paul Dumars, committee member.
Michael Conner, Finance Committee.
George Elmore, committee member.
Rick Miller, committee member.
Leanne Evans, School District Treasurer.
Scott Stitcher, PFM Asset Management.
Loretta McIntyre, School District.
Jack Warner, committee member.
Bill McDaniel, committee member.
I think
So our.
Bill Moore is planning to attend, so he may come in a few
Bill may be
minutes.
late, and, yeah, do we have any other staff folks? or attorneys?
No, Mike Burke is taking a well-deserved day off. He has been working pretty much around the clock on the sales tax referendum, on the referendum, not sales
I
tax.
went to an event that he was,
Yeah,
Yeah, he did a great job.
he mentioned that you were there and appreciated you being there. So he's out, and Blair Littlejohn is out on vacation today, and so it's just us.
so welcome again. Approval of agenda?
Motion to waive reading and approve.
Okay. All in favor?
Aye.
Aye.
Opposed? Motion passes. Approval of minutes of July 26th. Is there a second?
Second.
Any opposed? Hey, Bill, welcome. Good morning. We just started up. Here you go.
Thank you.
I think I'll have some of yours.
A lot of people in Palm Beach County,
A lot of traffic here today. We just started a minute ago. The only thing we've done is welcome. That's good.
Thank you.
So we're approving the minutes, all in favor, I guess?
Too many trees.
on
There's
that.
too many trees.
Public comments, and we don't have any public here today, as far as
No.
Our discussion items, the quarterly investment reports.
Okay.
And
Yep. Thank you all for coming. I hope you all had a great summer. It's been a busy one for us, as summers are always the busiest time of the year for us. And so fall is when we get to take a little bit of a break. Not so much this year with the referendum, but it's nice to see a little bit of change in the weather coming this weekend. So happy about that. We do have 2 batches of quarterly reports because we canceled the last meeting. There was a lot of conflicts at the last meeting, so we're doing 2. And since it's June and September, Scott Stitcher and I talked about this earlier, and I think what we want to do is focus on September for the market update, and because that's the current information. And the June quarterly information is the same as the annual investment report, so we're going to kind of combine these first 2 items together and cover all of them together. You have the individual reports, but we're going to try to go through it and focus on the most recent information. We are in compliance for everything, so happy to report that, but we want to give you the update of where we're at. So I think you wanted to start with the September one, or did you want to do June 1st?
I'm fine doing either, Leanne. Honestly, you know,
these are the materials.
if I make comments about the second quarter economy review, I mean, they almost mirror the third quarter. So if you like, we can go ahead and do the second quarter and annual review.
Okay.
I can keep, again, the economic, I was planning to keep the economic comments fairly brief anyway, but
Okay.
I think they're just so similar, they're probably going to say, well, Scott, you're saying the same thing. But I'm fine going ahead and
Okay.
reviewing the
So I've got the
second quarter.
annual?
Yeah.
Okay.
That works.
And we started off here with, I'll kick this off a little bit because it's got, it starts off with the report that we prepare for June. And while it says that we had $5 million worth of interest, or $5 million of interest as compared to $3.2 million for the general fund, our total interest earning for the year was over $11 million. So it was a significant increase over the prior year. A lot of that's due to rising interest rates. Some of it's also due to changes we made in the investment policy. So we were happy with the results that we have, and I'm hoping to see a similar increase in interest earnings for FY19. So as we keep going. So I'm going to kind of skim through this because I want to get right into what PFM does, because they're going to give you more detail than I do in the district report. So we'll scroll down. Or which page would you like me to start at?
I think
Right
that's
here?
the talking points is a good starting
Okay.
point. Yeah.
And there's a clicker for you.
Oh, and does it have a pointer if I were to need to point?
I think it does.
Good, good. I don't know if I will, but
Oh, I think that switched us to a different document. Nope, it's still there. It's still there. Okay. I think it moved you a page.
did I do that? I
See?
apologize.
That's okay. I think that button shifted it. Okay.
I'll be a little more careful this time. So again, I wanted to make some brief comments, especially around the second quarter since it is somewhat dated. But was interesting to me as I prepared for this meeting is how similar the third quarter was to the second quarter. So again, I jokingly said as I go through this, you're probably going to say that, you know, Scott's repeating himself, and it is probably going to sound like that a little bit. But briefly to talk about the second quarter and then the fiscal year end, despite a myriad of global headwinds and even at home trade wars, the economy continues to do quite well. During the second quarter, we got our second reading for GDP of 4.2%, very strong reading. And I think, I unfortunately haven't even gotten a look at the news today. I think we were getting the third quarter reading, the initial reading today, and I haven't gotten a look at the news to see what that says. But if you were to look at what's called GDP Now, it's something that the Atlanta Fed does on their website. It's a real-time GDP reading. Their indication would have been GDP for third quarter around 3.9%. So I'm very curious to see how close they were to their estimate. So the economy continues to flourish. Growth continues to be quite strong. Inflation continues to trend higher and at a measured pace. As a matter of fact, during the second quarter, we saw the PCE, the personal consumption expenditure, which is the Fed's favorite measure, hit 2% for the first time since 2012. We continue to see the labor market improve, averaging north of 200,000 jobs per month. Unemployment rate touched 3.8% during the second quarter. I think it finished a little higher than that. And then by the end of the third quarter, it actually dropped to 3.7%, the lowest reading we've seen since 1969. So multi-decade lows from an employment growth and unemployment rate standpoint. So with that said, all that bodes well for the Fed or allows the Fed to continue to raise rates. So they did so during the second quarter by 0.25%. They did so during the third quarter by 0.25%. And if you believe what the dot plot says, we'll probably see another rate hike before the year's over. There's only two more meetings left. There's one in November, one in December. We think that next rate hike will come in December. So then the wild card becomes what happens in 2018. We think anywhere from 2 to 4 rate hikes are realistic. Let me stop there and just see if there are any questions, thoughts, concerns around the economy.
What about what happens in 2 weeks?
Well, that's even, I guess, a bigger wild card, right? Yeah. Yeah, it'll really remains to be seen. And then whether the Republicans will be able to continue to move policy through the House. So, yeah.
The simple rate cut, I think everybody, I think now the possibilities are rated about 98%, so I think that's a foregone conclusion. I'm interested in your comment. You seem to be quite comfortable with your 3 or 4 comment. I mean, this has been about the hottest subject in the world in the last 10 days, say, for example. So, but you're still sticking with the 3 or 4 scenario in next year.
In 2000.
Year,
right.
2019.
Right. Obviously, that is very data dependent, as the Fed has been very, very clear about that. If you listen to the different governors' speeches, they say that it's very data dependent. I always joke that our crystal ball only goes out about 6 to 9 months, though, and we don't see any real issues out 6 to 9 months that would lead us to believe that the Fed could not continue to raise rates. I think what you really would want to focus on over that time period is if we were to start to see a tick up in the unemployment rate. The Fed has never raised interest rates while unemployment is rising. So I think you pay close attention to that. Again, we don't see any signs of slowdown in employment growth, but if you were to see a tick up in the unemployment rate, I think that would cause the Fed to pause at that point. But right now, everything leads itself to continued in a measured pace, okay? 25 basis point increases.
One of the things I was looking at, I had an economic update yesterday as part of the investment pool. We meet quarterly there, and they were looking at the yield curve spreads. And I don't think June is going to show the right picture, but it continues to narrow, the yield curve. So it's flattening, which is something that I'm keeping an eye on. Last time we saw that was just before the recession hit, so it's something I'm monitoring. And we're also going to be issuing some COPS issues, some long-term debt. And I'm happy to see that long-term rate's not rising right now, but it's something that I'm watching to see what happens.
Yeah, and that's a great point, Leanne, because that has been a great predictor of recession. I want to say it's predicted the last 5 or 6 recessionary periods. But, you know, one thing to note about that is you can stay in this flat environment for a number of months before we actually invert. So I want to say on average, looking back the last 3 or 4 recessions, maybe even 5, it's averaged about 20 months in the environment we're in now. But great point. It's something we are also looking at. Looking at the leading indicators are still points you to continued growth at this point.
What's the projected timetable when the Fed may potentially raise the rate again?
We think December is the next rate hike. And again, then 2019, we think we'll definitely see hikes, 2 hikes by mid-year. All talk is that the Fed is really trying to get to what they call a neutral rate, and there's maybe a little uncertainty around what that really is, but in the Fed's mind, we think that's 3%. So today we stand at 2 to 2.25 is the range for the Fed funds. So that would imply really that they're trying to get to that 3%, another 4 rate hikes. I think once they get there, they may pause, although they've even made comments that they're comfortable going past that. So being more restrictive. So that neutral rate implies, we're neither contracting or expanding. The policy, you're neither contracting nor expanding. They've implied that they're comfortable going past that, becoming a little more restrictive. But that's a long way out. Again, we have to really continue to monitor the data and see if it allows the Fed to continue to take action. But the next one is on the table for December. I want to say the probability stands at roughly 76, 78% of that occurring at this point. Okay. Let's get into.
You can use this to move from.
Is that easier to do?
It might be.
Okay.
You can use this to just scroll through the slides.
Slip this here just in case. Jump too far on there. Okay.
No, I don't think.
Let's start here then and get into some of the details of the portfolio. So again, this is a second quarter end report as well as a fiscal year end report. So I'll try and combine comments here where I can. So you'll note we ended the fiscal year with a total market value of $44 million.
And that's the core portfolio too.
This is the core portfolio, correct. $44,424,525. You'll note the yield at market at 2.4%, the yield at cost at 1.44%. We're going to talk a little bit later about the importance of that number. And then you'll note the duration at a 1.13 years versus the benchmark we'll look at later stands at about 1.8 years. So your portfolio has remained short of the benchmark from a duration standpoint, meaning that it has less interest rate sensitivity than the market, and has served you well, okay? You'll note, again, a very high credit quality portfolio. AA average credit quality. You'll note the sector breakdown between Treasury, agency, and corporate. So again, very high quality, very liquid portfolio with roughly 80% of the portfolio in Treasury and agency. And then as I noted, the duration's fairly short relative to the benchmark. One of the key drivers of a short duration would be shorter maturity securities. And you can see that referenced here on the chart below with roughly 47% inside 1 year. Let's look at what you're really most interested in seeing, and that is performance. And performance has been stellar for you. And I know if you're looking at equity markets, you may chuckle a little bit about that, but relative to other high-quality fixed income portfolios that I come across, your performance is very strong. So I'll point you to the end of the second quarter. Your performance was 0.40% versus your benchmark at 0.22% for 18 basis points or 0.18% of outperformance versus your benchmark. I also want to speak to the fiscal year end, so bring you out here to the 1 year number where the portfolio was up 0.76%. See if I can blow this up a hair. I know that number, that's a little bit easier to see. 0.76% and the benchmark at a 0.08% for 0.68% outperformance. We also share you the net of fee number as well there, 0.68 net of fees and 0.60%, again, outperformance net of fees. Any questions on performance or the structure of the portfolio?
One of the things I wanted to mention here is we're about to start a review of the core portfolio to see if we need to increase the size. Remember a few years ago we shrunk that down from about 50 million down to 40. And we're looking at cash, and I think we need to bump that up again as through the budget cycles we increase the board contingency, which is required by policy. That's a bigger number. And we also have sales tax revenues and some other things that are impacting that portfolio now. So we talked about that earlier this week, wanting to look at historical trends, and we're probably going to be increasing the size of this portfolio so we can put some more money out a little bit longer, which is good timing as rates are going up. It's a good time to try to manage that.
Yeah, the one thing I failed to say, and again, the comments hold true for the second quarter and for the third quarter, is that the 2 year rose by about 26 basis points during the second quarter. And the 2 year Treasury is a good proxy for your portfolio. So you kind of follow what the 2 year Treasury is doing, gives you an indication of maybe what your portfolio is doing. And the 2 year sort of mirrors what the Fed is doing as well. So it tends to be more impacted by what the Fed does, whereas the longer end of the curve tends to be more impacted by what the economy is doing, okay? So despite the fact that interest rates were up by about 26 basis points during the second quarter, your portfolio still managed to have a positive return. And that is just given where we are now in this rate cycle or the tightening cycle. So I know I've had conversations with my clients about how it's going to be painful initially as the Fed started to raise interest rates, as we started to see some negative returns in some cases. But now we're starting to get to that point where it's a little bit better. It's still going to hurt a little bit because you're still going to see some price depreciation in the bonds you own. But now you have higher income, and Leanne already hinted at the hope of having higher income next fiscal year, which I don't think you have to worry about, Leanne. I think that's a given. But that higher income acts as that insurance policy or buffer against those price fluctuations. So despite yields rising during the quarter, you still maintain a positive return of 0.4%. And that, again, is just given where we are now in that rate cycle. So it's very positive. You know, the days of 0% yields are behind us, which is kind of exciting. Let's move forward. I'm going to pass through the accounting. I think that will probably only upset Leanne.
No, it's fine.
And I want to talk a little bit about the sector allocation. So this allows you to see what went on from quarter to quarter. We show the 4 previous quarter ends, so it also gives you a good idea of what we did during the course of the fiscal year. And I will be honest with you, we're pretty quiet in the portfolio over the last year. You'll note we are a little bit lighter in agency. We started the fiscal year at a 44.9. We ended at a 43.7%. Again, that's kind of in line with where we were quarter over quarter. Where you see a bigger move quarter over quarter was from Treasury, from 43.2% down to 40.7%. Again, though, really in line with where we started the fiscal year. I'd say where you see the biggest move is in corporate, and that's kind of consistent with our theme within the firm. We've tended to favor credit over the past couple years for a couple of reasons. One, it tends to be less sensitive to what the Fed is doing, and it tends to benefit from a strong economy. And we've seen that be very beneficial in this environment. So from the end of the first quarter, the end of the second quarter, you see a large move in the corporate space. Again, not much greater from where we started the fiscal year, but again, we really have favored corporate notes in this space. The Muni holding matured in May, so this wasn't an active decision on our part. It was just a Muni that matured in May, and we put that money to work in a corporate note. I mean, we're finding opportunities out there now in the 3% range. So you are definitely going to see the yield at cost on this portfolio continue to trend higher, and we'll look at that when we talk about the third quarter report. You'll see I mentioned earlier that the yield at cost on the for the second quarter in this portfolio stood at 1.44%, and we'll talk about what the third quarter stood at here in a second. So any questions, concerns on actions that we took during the course of the quarter or the year in the portfolio? Okay. Stop briefly here. I mentioned duration being short. You know, Leanne already mentioned the fact that you'd taken some money out of this portfolio. That action really led to a shortening in duration, but it has benefited you tremendously to be short the benchmark. So today you're at a 113 versus 1.8. You see what that distribution looks like by maturity here, and then by contribution to duration here. So this kind of gets into the weeds when it comes to fixed income, so I don't want to spend a whole lot of time here, but I will just say that you have a lot of dry powder here to employ out when securities mature to buy higher yielding securities. And again, that's only going to benefit you in the long term. So the short-term portfolio spent down during the quarter?
Yeah, the short-term portfolio, and this is actually what we're spending a lot of time on right now. Tax revenues will be coming in starting in November and then in December, and we ladder out securities and have them mature as we need money. And of course, we just did the TAN sale to bring in more cash. So normally this looks just like this at the end of the year, where there's no money there. We're already starting work on how we're going to set up that portfolio for next year. And I'm actually doing a training session November 7th in Sanibel or Fort Myers for the State Finance Conference, specifically talking about short-term portfolios and how you choose between pools and how much money you keep in your bank account to offset fees and all that. So I'm doing it there, and then we're going to do it here as well for my staff. So I was going to do it anyways, and it's now become a state presentation, and I'm actually partnering with Leslie Allison from PFM and the FEITF pool to try to do that. So I'm probably going to make that available so you can see it, because it's just an interesting way of looking at how to make choices, and I think it'd be helpful for y'all to see how we're doing that. And we'll be following that starting in December as tax revenues are coming in.
Well, it's an interesting period because next year, obviously you move. If you don't believe interest rates are going to continue to go up in 2019, then obviously moving your duration out now is I mean, you got really, and politics has a lot to do with it too. So I mean, we have a new member of the Federal Reserve participating in the process, and it's I'm speaking of the president, not Mr. Powell. And so it's a really kind of an important question, because if you believe, like I do, say for example, that that 4 and 4 or 5 next year is going to happen, is not going to happen, then obviously, you know, you might want to load up the boat for a little longer
Yeah.
duration.
Well, we treat these two portfolios very differently because the short term, when it comes in, and we'll have a discussion, I'll have a discussion with PFM one day in early December that I have $500 million I need to get placed as quickly as possible. And what we do with that is ladder it. So I kind of ignore the politics because we need the cash when we need the cash.
Oh, of
and it's
course.
all
I
less
mean,
than a
yeah,
year.
yeah.
That's the biggest chunk of our money.
Yeah.
So if I can move that from the bank out to investments or into pools to get the higher amount, that's great. Where we're going to see the big impact is with that core portfolio where we can go out longer and you really do see the impact. So it is going to be an interesting year to see what happens.
Sorry,
I'm actually hoping that I pick
I
up,
understand that we're talking about really short maturities and
Yeah.
a few basis points, but even
Yeah.
so, it's an interesting time to be trying to sort out how you,
Yeah. Well, you know, I was looking at it and they're going to be raising rates. And I think they are going to push to do it because I think they want to get to that neutral spot. Because if we're moving into a recession, their key way of dealing with recession is with interest rate reductions. And if the rates are too low, they've taken one of the big tools out of their toolbox. I think
Right, you're
that's
right,
behind the
exactly
scenes.
right, yeah.
But it's going to be an interesting year.
And to your point about the newest member of the Fed, you know, hopefully Jay Powell will continue to do what he's charged with doing and not
Yeah,
let
well,
that
I think
influence.
I think most sensible people
We'll do that,
buy
right?
that, but on the other hand, you know, if the economy does take a tip down, maybe they might revisit
Maybe,
that.
I agree with that. And the one thing I pointed out to some folks that brought up that the same point you're making at a recent meeting was that Jay Powell's term runs 14 years. So he may take some heat from his boss.
As a governor, 14 years.
As a governor for 14 years,
4 or
correct.
5 years as the chairman.
Correct,
Yeah.
correct. But, so I think his term will well, I know his term will last longer than
Yeah.
Trump's,
Well,
so.
all I'm saying is that it's a question. I mean, certainly the December case, we can't, I mean, they would be suicidal for
Right.
them to not raise rates
Right.
in December after Trump has opined on
Yes,
the matter.
yes, I agree. I agree completely. Well, let's finish the second quarter and the fiscal year end report with what we see as probably one of the most important pages in the presentation, and that is the asset allocation slide, which is a quick snapshot for you to look at the assets under management to determine that you are in compliance with the district's investment policy. So this is a somewhat new look for us. The gold bar now represents the maximum allocation percentage permitted by policy. And then the blue bar represents the actual allocation. So here's the actual percentage and then the amount permitted by policy. So kind of think of it as a fuel gauge. Only in this case, you really don't want it always to be a full tank here. So we are bumping up against it at the end of the fiscal year end, and from a pool standpoint, your bank account, you know, again, there's some room there. You're allowed 100% in demand accounts. You're at roughly 70.3%, but no other issues. Again, looking across at the other sectors. But again, it's a good tool for you to quickly gauge whether you're in compliance with the policy. The one thing I always note, and this is by sector type, this page.
Go right back
okay,
up, because
sure.
the way I look at the investment policy for investment pools, you have investment pools and Florida Prime, they're both investment pools. And I think the policy is 50%, but 25 for each one. So the investment pool that's there is FEITF, and because we haven't put any more money in Florida Prime yet. So that's something that we're going to be looking at Because by policy, I think in the policy, it's 50% for total pools, but 25% for each one.
See right there.
So we have to break out each one. One of the things that I want to look at is possibly increasing the amount we can do for pools overall, keeping it at 25% per pool, but to try to give us some more room there. And we'll talk about that in December, about possibly making another change in the policy.
Do we have enough pools? Are there enough pools?
And that's part of the review I'm doing for this presentation in the next 2 weeks. There's 4 or 5 of them out there. One of the things that we're going to be doing with the quarterly investment report, which you don't see here yet because it doesn't apply, but as we start using more pools, what I'm developing in this presentation is going to be a summary that's going to be added to the investment report that's going to give you a summary of information about each pool, who the fund manager is, the percentage, the composition of the pool. I want to make sure if we're using more pools. I mean, I'm very involved in FEITF. I'm on the advisory committee. I'm getting updates monthly, so I'm really comfortable with that. But as we start looking at other ones, I'm not as involved. So I want a way to develop and review those. And the training that we're going to do, it's not going to be just me. It's going to be everybody in my department that can help review these things on a regular basis. So if we do have more of them, we need to pay more attention to them. It's not like investing in treasuries and agencies and some very high-grade corporates. These have all kinds of things in them, and we're going to have to do more due diligence. So before we go there, I need another tool that I can then report back to you so you can see what we're doing. So I'm developing that right now.
How is Florida Prime stacking up against our intergovernmental pools?
Their net rate is a little bit higher than FEITF because their costs are less. The gross return for FEITF is actually higher than Florida Prime. But they've got their partially subsidized by the state, so that's the difference there. The last time I looked, the composition of the pools were very similar, but some of the other pools have very different compositions. So they have some more risk associated with them, which makes me a little nervous. So that's why I want to make sure we do a really good review before we start using them. But the investment policies, it is my toolbox of what we can do. So I want to make sure we have enough options to maneuver and to do what we need to do.
Is the intergovernmental pool really the one you're talking about, the FEI?
Mm-hmm.
That's what it is.
That is. And a lot of that, and I think FEITF is about the 224 million at the bottom. 118 million of it was the TAN proceeds. So we did the TAN proceeds. FEITF has 2 options. They have an overnight, which is a traditional pool, and then they have another one that's a term product where when the TAN, and we just issued the TAN in September, closed beginning of October, when the tax revenues come in December, I'll be placing that, and I'll say I've got $115 million to invest until August 28th, and they'll lock in a portfolio that day based on that maturity. So the 224 million, 115 of it was the TAN proceeds.
How big is the pool?
The pool is currently about $970 million. It was
roughly 25% of that pool.
Well, the pool has changed a lot because now we have a lot of cities and counties and special districts in there. It's not just school districts anymore. And as of the update I got yesterday, which I think was the September 30 data, school districts only provided 36% of it. The rest of it was other governments, which is helping even out the cash flows. You don't see the big dips that you see with school districts because we all have the same thing, the money coming in and going out. So adding in a lot of other entities has leveled that out. I think at one point we were up to 1.5 billion. It's really grown significantly. So when we had that in there, I'm trying to get to where we're a smaller piece of that pool.
Yeah.
And that really has happened over the last year. Right now, we're down to about less than 100 million. So we're about 12% of the pool.
What do you at PFM think about that?
Well, we manage it, so it's nice.
So you're good with it.
Oh, we're very good with that. Yes, yes. and we're trying to actively support Leanne in her efforts to increase the assets to help diversify the investor base as well.
If it was another pool and I wasn't seeing the backup behind the scenes, and I get those reports and I'm on the phone with them, we have our regular updates, and I usually have at least one other call with the managers of the fund because I'm calling them and talking to them. So it's a little different.
It's our pool.
I just have a lot of insight in that particular pool, and I want to make sure I have the same type of insight or something close with any other pool before we jump into it. So
That's going to be difficult.
it will be. So there's going to be some type of summary document that we'll add into the quarterly investment report, hopefully for the January report. So you'd see that at that meeting I think it's in February, and you'll get to see that for the first time. Whether we invest in everything else or not, you'll still see it with FEITF. And we have a little bit of money in Florida Prime. I think it's $33,000. It's a small amount that's there. It's just what's always been there from the beginning. We haven't added any more in there, but before we do, I want to have something, and I promised the committee we'd do that, have some extra backup so you can see what's in those pools. And if I can't get comfortable, we won't do it.
That is the challenge, because not all the pools are as transparent as, say, the Prime, which if you go to their website, you can do a pretty deep dive on that
Right.
on that pool, as well as FEIT. I think we are very transparent, and then you have the additional benefit of Leanne being on the advisory committee, so she's hearing directly from the portfolio manager. But that is definitely a challenge, is to the transparency of some of the other pools in the state of Florida, to get your arms around it. Not to get too far into the weeds, Leanne, but
Go ahead.
one of the recommendations we would probably bring in December is around the allocation permitted by policy to money market funds and intergovernmental pools. Our recommendations more recently have been to lower the money market allocation and increase the intergovernmental pool allocation. The main reason being revolves around money market reform, which is now pretty dated, but the key benefit to lowering the money market, increasing the intergovernmental pool, is the stability of the NAV that intergovernmental pools bring to the table, whereas a prime money market fund would not offer that safety, that stability. So we think that intergovernmental pools have become more favorable, a better tool than, say, a prime money market fund historically was. So that's
So
kind
you
of
think
one
the
of
new rules have actually destabilized somewhat the money market funds?
No, not so much. I don't. And actually, I would say, if anything, the money market space has stabilized, and you're actually starting to see a tick up back into prime money market funds today. Nowhere, they're not at levels like they were back in 2008 or before the reform. Nowhere near that. But I'd say it actually is stabilizing. You're starting to see assets start to flow back. Now, again, those are for folks that don't have that concern about a stable NAV. Our client base would not fall into that camp.
Right. When I look at money markets, and we have a very small amount there, and that is money that's with Bank of New York. It's debt service payments that we had sent to the trustee, and they've got small amounts that are up there, and that's spread over probably 7 or 8 different accounts. When I look at money market funds, that's overnight money for us. It's money that's put out that we're going to make payroll with in 2 weeks. I don't want to take a risk of that not getting back everything I put in. If there's not it's just the way we use the money market. I want that stable net asset value for very short-term investments, which is what this is for us. So we're not actively using money markets. This is just money that was sent up to the trustee. It was there till August 1st, and it's been pulled out, and there's very small amounts there based on interest earnings that happened between June and August 1st. So it's not something that we're looking at using. I'm using pools instead.
In these so-called governmental pools, so would you said there what, 4 or 5? You said, I think. Do you really look at for lack of a better term, you really look at the people? I mean, here's Fred here, who's managing this thing. What's Fred's background? I mean, what is he? Do you really know what the hell he's doing? I mean, these are questions that I frankly have a little more concern about with nonprofit enterprises than I do with profit-making enterprises.
Right.
I mean, I presume that's done, but I can't imagine. I mean, there've been, I guess, in New York State at least, there've been maybe not related to these short-term money market type operations, but longer term, lots of unsavory. There've been the cases unsavory activities from time to time, and. That to me, I mean, whether the thing works well and they know how to take in the money and account for it properly, but rather who's really the chief investment officer the most important
Right.
matter as far as I'm concerned,
Okay.
not the mechanics of it all
Right.
and so forth.
Well, when I come back to you in February with the summary of the pools, and it's the money markets as well, we'll view that one as the first draft. We'll bring it in, and I'll look for your feedback. What else would you like? What else do you think we should be looking at? So,
Well, I think that's the most important thing.
Okay.
I'm sure
Oh,
you do.
yeah.
I know you do that. I'm just saying, I think really you ought to.
Well, I think the only thing that gave me comfort is that PFM is the
Yeah.
one that's managing this FEIS
right,
pool.
right,
And that you're on that board.
right.
Otherwise, I think putting all your money in
Yeah.
one kind of bag, this is kind of your own bag.
The way I'm right now, but with FEITF, that is almost like a separately managed account because I need the same level of detail.
Right.
Is that I won't have that same comfort with other pools and other funds. So that's why I'm trying to develop something that's a reporting mechanism with multiple people in the office that are reviewing it so that we can make sure we're never going to get that same level unless I can get on the board of each one of those. And I don't think that's going to
Well,
happen.
that wouldn't help after a while. 'Cause it's too thin.
Well, and it's just, you just can't do that. We've got our own things to do here as well. But I've got to figure out a way to get super comfortable with them before I use them. And that's why last year, I think this time I said we were going to put money in Florida Prime, we were going to do other pools, and I didn't because it wasn't quite there yet. I haven't got what I need yet. So I'm hoping to get there in January because we're going to need to do something. The bank balances are very high, but our rate that we get with our bank is really good. We had a great rate, but as interest rates start to rise, it's not going to be as good comparing it to other sources. So my goal is by the end of next year, get that down to bank balances are significantly less. I'm hoping we end up at like 50 million instead of 600 million at the end of the year. But that means I've got money in a lot of other places, and a lot of that is very short-term money. I can't be buying treasuries and agencies for a 2-month or a 1 month. It doesn't work. So pools are the logical solution there. So I've got to find a way to get comfortable with that.
Yeah. Let me ask PFM, that much money in the bank, is that a danger?
At the bank,
Yeah.
well, given Florida has the qualified public depository requirements,
Just cover it.
I'd say, and let me just stress too, with the QPD program comes the need to report to the state. That's the real key. If you don't report to the state, then the QPD program doesn't do you any good. But as long as Florida has a QPD program, and I know Leanne's doing this, Leanne is filing her paperwork to the state on time, there really shouldn't be much of a concern on your point, or on your part. Now, keep in mind, too, if there was an issue with the bank, you're not going to get that money back immediately. So there is going to be a liquidity event, but you will get your money back at some
Right,
point.
it's secured by Treasury.
Correct,
Right.
correct.
Right. And we do the report every year. In fact, Brenda is working on it right now. It's as of September 30 data. It's due by November 1st. We're waiting for one more bank statement to come in on one of the risk management accounts. So we'll be filing it. So we do that. But I am not comfortable. It was the best place to put the money. But what we're talking about now is changing the way we're managing the money and having much more invested. So I was sitting back, I was on vacation last week, and one of the things that popped into my head is that nobody in my office was here managing cash 10 years ago before the recession. So I've got a lot of training to do and talking to accounts payable and risk management, the people that come to us and say, I need you to wire money out today. If I'm investing longer and I don't have the cash in the bank, it changes the operation of the district. So one of the things we're working on right now is to do that training among all the different departments and make sure my staff are very comfortable with how we do this, getting down. I mean, years ago, if I go back 12 years ago, we used to have cash balances less than $1 million. Well, it's not going to be $1 million because I'm including all the school bank balances now, and we're managing all those schools. And that money, I don't know what their cash flows are. So their money will always be in the bank. And that's about 25 to 30 million, depending on it. Sometimes it's higher, but that's an average. So that's why I was thinking eventually have no more than 50 million in the bank. So I've actually got this as one of my goals for the year, and I've spelled it out with Mike Burke. This is our goal over the course of this year to shrink that bank balance. One of the things that will have to happen is a discussion with the board because, and it probably will be, a write-up that I send out to them. When the bank balances shrink, we're going to start paying bank fees Because right now, the balances are in the bank that are offsetting the bank fees. The bank, when we take the balances out, we're to pay bank fees, but that money's then going out and being invested and earning more interest. So it's a wash. But when you see a report and you're paying $200,000 in bank fees, I'm going to get questions from the board, which is expectable and understandable. I want them to know in advance before that happens, because we haven't had bank fees in 10 years because of the way the interest rate environment was. So it's something I'm going to be working on, and hopefully you're going to see these balances shrink over the next year as we work through that transition. If it was just my office, I get people up to speed, and this is how we want to do it, and build the templates. We could do it within a month or two, but it's not just my office. It's how we function. When real estate is buying a piece of land and they call legal, and legal sends me the note, here's the information on the wire, they need $10 million. I don't necessarily have $10 million in the bank. So it's trying to work with all those departments to get them up to speed, that we're going back to the way a normal banking environment is. I mean, it's just been 10 years of very unusual management of funds.
Now, let's go back to Florida Prime for a second. I know we dissed it a long time ago, and
You undissed it.
properly, yeah, but we're not using it still.
We're not.
And so how does PFM feel about Florida Prime? Particularly because this intergovernmental thing, other than the one that you have direct
Right.
control over, it may not be a good alternative, really, for the reasons that Bill indicated, that you don't know the management of.
I'd rather have a money manager who's making $2 million a year than one who's making $50,000 a year. I'll tell you that for sure.
Well, Florida Prime they're using Federated to manage their money, so
There you go.
they're using a big organization. So I'm not as concerned, I'm much more comfortable with Florida Prime than I am a lot of the other ones.
That's what I would think.
Yeah.
Yeah, that's-
PFM?
It's always hard to endorse a competitor's fund, but I'm asked to do it quite often, and so I'll do my best to be very politically correct here. But honestly, I think Leanne hit the nail on the head. So this is not the same fund that it was back in 2007, 2008. It really is not. As Leanne mentioned, they now have hired Federated. Federated's out of Pittsburgh, very reputable asset manager, billions of dollars in assets under management. They've been managing short-term money for decades. So the other benefit is, again, Leanne alluded to this, is the low fee. Fees are important when it comes to investments, right? Fees do impact your return. So that it does have a low fee, and it has a very attractive yield. It is diversified, and I think it does look very much like the FDIT fund from a diversification standpoint. I think people forget about diversification and the importance even in the money market fund space. It is important. So that fund, I think, ticks all those boxes. Again, it is not the same fund that you held back in 2007, 2008.
Back in 2007, when we had the crisis there, you could not find the list of securities, what was in it. You couldn't get it. We ended up getting it because somebody in Leon County walked over there and knocked on the door and asked for it and got a copy, and then it got disseminated. And that's how we found out about the issues, because it just wasn't available. Now it's online. Everything is available. They are extremely transparent. And their total fund, I think, is over $6 billion last time I looked. So it's a huge fund, and it's being used by all the governments throughout the state. I think we still have that very small amount in there. I think we're one of the few school districts that aren't using it. With the last investment policy change, we added it back in and said we could use it as long as it was managed by a professional money market fund. I think that was the language that we added in. It can't just be managed by the state board of administration. So that's in there, and I also committed that before we put more money in there, I'd find a way to bring more reporting back to you. So I think we're going to go there this year, so I'm going to bring you some kind of report, get your feedback in January, and we'll move on for February and move on from there.
Okay.
It's Solid Waste Authority. We lean on that one very much.
Yeah.
On Florida Prime?
Yes, we're comfortable with it. Make sure that they are who they say they are and so
Yeah.
forth. So we're comfortable with it.
Right.
And PFM advises us to some degree.
So we do have some changes, and we're talking about investment policies and things. So In December, we will be bringing the policy back. Two of the other things that PFM has suggested looking at, and I said I want to make sure that we're bringing information to you when we do that, but adding in the option for asset-backed securities and for supranationals. I said, we'll have a healthy discussion about that in December before we put that into policy. So usually the December meeting is very light. I think we have some really solid topics that we're going to be discussing at that meeting.
Great.
Okay.
Yeah. No, that's all I had as far as prepared remarks for the fiscal year end. So if you want, we can
Okay.
go get into the third quarter report.
Does anybody have any other questions on this report, which is June, and it's the annual report? Okay, so let's go back, and I'll pull up.
And Leanne, while you're doing that, I'll just make one quick comment. I had a little pop-up on my screen here while we were talking that the third quarter GDP number came in at 3.5%. So I'd mentioned that the Atlanta Fed GDP now, which is that real-time number, was at roughly 3.9%. That was a number I'd seen last week. So I feel like 3.5% is in the ballpark. So pretty strong reading for the initial reading of third quarter GDP. So the economy continues to look good. Corporate spending, consumer spending, all driving that number.
Okay, so
Okay.
here's the September report.
And again, sounding like a broken record. Solid job growth, low unemployment rate. I mentioned we met multi-decade lows of 3.7%. Last time we were there was 1969. Record corporate profits. Inflation continuing to trend towards the Fed's long-term target of 2%, which again will allow them to continue to raise rates. We talked about the potential headwinds of tariffs. Again, we don't know what the impact's going to be there. We have to let time play out to see what that really does. But another strong quarter for the third quarter. Again, the initial reading for GDP looks very strong. We saw rates rise again. The Fed did take action. I mentioned that earlier. They rose rates by another 25 basis points. The 2-year, again, the proxy for your portfolio was up by about 29 basis points. And despite that, the story is still very good from a performance standpoint. So with that said, why don't we get into what you really want to see? I don't know, again, if we need to spend a lot of time here. There's the GDP, which is a little dated as of today. And there's your inflation gauges, CPI and PCE, again, PCE being the preferred measure, but again, moving towards that 2% number, the favored 2% target of the Fed, everything moving in the general direction that would allow the Fed to continue to take action. And one thing I probably haven't mentioned is consumer confidence is at decade highs too, multi-decade highs as well. So everything seems to be hitting on all cylinders at this point. I mentioned the Fed dot plot would indicate 2 to 4 more hikes next year, and the economy continues to give them the fuel to do that. I mentioned the 2-year up of 28 basis points 29 basis points during the quarter. It's hard to see that from here since we're looking at year to date versus the end of 2017 and 16, but you do see the impact of the yield increase or rate hikes and increases in yields considerably here again in the 2-year. But again, let's look at what that really means from a performance standpoint. I apologize for scrolling through this. I'll stop briefly just to look at some of the statistics of the portfolio, and then I will share performance. So we ended the third quarter of 2018 with $45,027,088, and again in the core portfolio. You'll note the yield at market at 255, and the yield at cost at a 164. So recall that at the end of the fiscal year, the yield at cost stood at a 144. So basically what that's saying is, as we add new names in the portfolio, we're doing so at higher yields, and you're seeing that yield at cost number tick up. And that higher yield, again, it acts as that insurance policy against price fluctuations in the portfolio. So that yield at cost is an interesting and important number. The duration, in line with where we were at the end of the fiscal year, you'll recall we were at 113 at the end of the second quarter. We're at 116 at the end of the third quarter. So maintaining that short duration. Obviously, that would change if Leanne decided to add some money to this portfolio. You'd probably see that number drift closer to the benchmark, but I won't say it won't be on top of the benchmark because we have maintained a duration stance short of the benchmark for some time, not just in your portfolio, but in our clients' portfolios, and it has served them well in this rising rate environment. So I mentioned earlier the dry powder, that everything inside 1 year. Again, that can be deployed to longer-term money or longer-term securities and higher-yielding securities. Again, high-quality securities, AA. One thing I should note I didn't do at the end of the fiscal year-end report, you do note a small allocation to BB+ names. I'm sorry, I've done something. Thank you, Leanne. A small allocation to BB+ names. I should have mentioned earlier at the end of the fiscal year report that you're not out of compliance by having these names. What this is this report reflects S&P ratings. Your policy states it has to have two ratings by two of the what do they call them? NRSROs, nationally statistical rating organization, nationally recognized statistical rating organizations. So this is only S&P, which would mean Moody's and Fitch rate it A or higher. The two names that make up that 1.5% is, I want to say, Morgan Stanley and Goldman Sachs. And so, again, BBB+ by S&P, but A by Moody's and Fitch. So you're not out of compliance from a rating standpoint. Again, I apologize for not pointing that out earlier.
And it's short-term commercial paper for them, if I remember correctly.
I think we actually have some longer
Okay.
dated names too.
Okay. Well, I was thinking for those two. I thought I remember those being commercial paper, but I could be wrong on
Okay.
that.
We can look.
It'll be down here.
Okay, but again, average credit quality AA in the portfolio. Spread across, again, very high liquid, high quality sectors, U.S. Treasury and agency, roughly 80% of the portfolio, with another, we'll call it 20% in corporate names. So that's the breakdown of the portfolio, not vastly different from what we were just looking at the end of the fiscal year. Again, the biggest change may be in the yield at cost, and that's the number we want to see rising as we do performance. So let's look at performance. I'm going to go to the same slide we looked at for the end of the fiscal year, which includes the 4 previous quarter ends on a gross and net of fee basis relative to your benchmark. So the end of the third quarter, the portfolio returned 0.47% versus the benchmark at 0.19%. So again, in a rising rate environment, we're now generating positive returns in your portfolio. That is outperformance of 0.28% on a gross of fee basis and 0.26% on a net of fee basis. This is pretty exciting, actually. Starting to sound a little bit like a bond geek here, but going out and looking at a year, your return for the trailing 12 months is almost a full percentage point. It has been a long time since we've been able to say that. 0.94% for the trailing 12 months. That's about 90 basis points of outperformance relative to the benchmark. You see the Treasury at about 0.04%. So I think I probably won't be here at the next quarterly presentation, but I'm going to go out on a limb and say you might see that number north of 1%.
That'll be February when we do that.
Yeah. Let me stop there. I've thrown a lot at you from an economic standpoint and the structure of the portfolio and performance. Any questions, thoughts, or concerns? Again, I know I probably sound a little bit like a broken record. It's very similar to what we looked at the end of the fiscal year. Okay. I'm going to just stop briefly on the sector allocation page and again just look at the fiscal year end relative to the most recent quarter end. And the thing that will jump out at you is we are much lighter in agency, 43.7% versus 8.7% in agency. That was, I will say, that has been a strategic move in our clients' portfolios. In your case, you actually had a maturity. So in a lot of our client portfolios, we've actually been selling out of agency, taking gains, and allocating that money elsewhere. In your case, we didn't have to actually do that trade because of the maturity that occurred in a Federal Home Loan Bank security. But you'll note that we did not reinvest that in agency. We did deploy that out into some corporate names. And again, that's consistent with our theme. We've favored credit in this environment. As long as the economy continues to do well, we're going to continue to add credit where we can. And I'll say that's the biggest change that took place over the course of the quarter. And I don't like to use that word change. I'd say it's the largest enhancement that took place over the course of the quarter. I'm going to go to, we talked about duration. The short stance has helped you. I'm just going to stop, as we did at the end of the fiscal year, and go to the asset allocation slide just to show you again. We've got transaction data here. We could spend a day going through the transactions in the holdings report. We also include it by date now as well. And then we now include your quarter-end statement in the back of the book, another enhancement to the portfolio. There's really a lot of detail in this report. But let me stop. Oh, I forgot about the shock analysis. You want to spend some time on this?
Yeah, go ahead.
Okay. Yeah, and actually this is a pretty interesting story that ties with, again, your portfolio, and now that rates are rising, we're still seeing positive returns. So you'll recall when we do this, what we call shock analysis, we do an instantaneous shock. We show information from an instantaneous standpoint, meaning if the Fed were to step in and raise rates by X percent, what would that mean for the portfolio? And then we show you what that means over a 12-month period. But an interesting story, there's data or verbiage here that shows you an instantaneous shock of anywhere from a negative 50 basis points to a positive 50 basis points would impact the market value of your portfolio by a range of $44.8 to $45.3 million. So the interest rate shock down would increase the portfolio. Interest rate shock up would decrease the portfolio. And here, let's look at it, instead of words, let's look at it on a graph. So here's that instantaneous shock of 50 basis point increase, and the market value would fall to 44.8. However, a decrease in rates would see the value of the portfolio increase to 45.3%. What's that mean from a total return standpoint? Again, a slightly negative return from a percentage standpoint, positive in that range. But again, what's more interesting to me is this horizon analysis. And you all are living it right now. Even with a 50 basis point shock, you would have yield income of $1.3 million, a price change of a negative $370,000, but still have positive return or total market value change in the portfolio with a 50 basis point shock. So that was what we were talking about earlier, is that being in a better place today and having the ability to clip a higher coupon. So we show you what that means in market value and what it means from a total return or percentage standpoint. And again, a 50 basis point hike over the next 12 months would still equate to positive return and positive earnings in the portfolio.
Just so you know, I get this same information on the investment pool. They're doing this same shock analysis, which is really helpful when I'm looking at how we're managing the money.
And I'm sure a very similar story at this point, right?
Mm-hmm.
And then lastly, in the shock analysis, we look at what a one-notch downgrade would look like to the portfolio. And I think it's interesting to note we exclude Treasury and agency. Okay, I think the assumption there is you're going to get your money out of a Treasury and agency security. But we shock the portfolio by a one-notch downgrade. Again, in your case, I mentioned earlier that 80% of your portfolio is Treasury agency, so we're really looking at the other 20% of your portfolio. And you'll note that a one-notch downgrade, and I do probably need to sneak back to the verbiage here. I apologize. So after all credit downgrades, you'd see Goldman Sachs and Morgan Stanley would be rated BBB by S&P, and it would result in a policy warning. So again, a warning, technically you're not out of compliance because the policy reads that you have to be in compliance at the time of purchase. But we would make you aware of an actual downgrade and work with Leanne on actions to take. We'd provide our recommendation on whether we'd be comfortable continuing to own that name. And then from there, we would obviously follow your direction on whether to keep or sell that security. But in this case, you really only would move from, what was it, 5 to 8%? 2 to 5%, I'm sorry, 2 to 5% in BBB space. So again, I would say no real concerns from a shock standpoint, from a rating standpoint.
That's just looking at the core
It
portfolio,
is,
right?
it
It's not
is.
looking at the entire portfolio.
Correct. It is core portfolio only. That $45 million. Any question? Excuse me. Any questions on the shock analysis? Okay. And then I will stop where I thought I was originally going here, but just looking again at the asset allocation chart, you'll recall we were kind of bumping up against that allocation limit in intergovernmental pools. That being spent down a little bit now. But again, no concerns from a policy standpoint, from a sector, at the sector level, and we always show you again the individual holdings as well on this page. And as I always point out too, and Leanne knows this, that if you were out of compliance, we would be having a conversation with Leanne well in advance of me sitting here in front of you this morning. And it happens. It does happen. Sometimes a large cash flow occurs that you're not anticipating. It may throw you out of compliance. What we do is, though, again, have that conversation. We footnote what occurred and what actions are being taken to bring you back in compliance. Okay, so there's no surprises if anyone were to pick up this report without PFM there or Leanne there or the committee there to explain it. They would understand what took place and why.
We're tracking this as well in our system in Simpro. We're tracking it, and then when it comes to the money markets and intergovernmental pools, we're actually, the way we manage cash tracks that daily. So we're checking it every day, not just at month end. So I've got somebody in my office that works on cash every day, and she's never here because she's upstairs doing cash right now. And she manages this every day. When we get close, she's in my office. Leanne, we're going to have to sell some off here and rearrange things. So we're managing that daily.
Leanne, I just wanted to go back and just
And see where
for those folks from Missouri, right, that want to see this. There's Goldman and S&P and Moody's.
Yep.
So Goldman at BBB plus and A3. Okay, and then Morgan Stanley is the other piece. So those two make up that 1.5%. But again, you're in compliance with the investment policy, so no issues there.
When you say out of compliance, though, I mean, you're in compliance at the time of purchase, but you now have a situation where you're out of compliance.
Well,
What do you do then? What does the policy call for?
The policy is
I mean,
based on when
you
you
would
purchase.
if you had to purchase it today.
Right. If I wouldn't purchase it today.
Right, but if you
But
had to purchase it.
If we had purchased it and then it changed, we're still in compliance. It comes up.
I get that, but what then do you trigger? Do you trigger a reconsideration of that investment?
We look at the options and see what we want to do. If it's going to be maturing in 30 days, I'm probably just going to leave it as it is. I wouldn't want to try to sell something at
We have a
potentially a loss.
policy on what we do in that setting?
That is left up to, I think it's left to me to decide how to manage it. But we can make a note and look at that when we look at the policy.
I would think so. I
Next-
think
in January,
if you're out
December.
of kilter, you want to have some sort of measure to give you a time frame to deal with it, or even decide not to.
Right.
Which is kind of what we do, but maybe
Right.
maybe memorializing it in the policy, maybe that does make good sense.
I will be sending the policy out. I'm working with PFM. I want their recommendations first. So we'll have that, and I'll probably send it out with the recommended changes in advance of that December meeting. We actually already have changes proposed On the debt policy, there's some changes to 15C212 that have to be built into really the debt procedures. The policy just says you have to be in compliance. But we're reevaluating a lot of things on both the investment side and the debt side. So my goal is to send those out to you so you have them in advance, and it will be redlined so you can see the changes. Some of them are just, I found some typos. Every time I look at these policies, I'll find something that, I don't know how that got passed, but an extra word in a sentence or something. I already found all those. And then we're making other changes. I've sent it out. The debt policy's already gone to the attorneys. The investment policy has gone to PFM for review. And the debt policy will actually also be sent out to all the underwriters. I always send it to all of them, as well as the procedures annually. So that's happening now. And the plan is to bring all those back to you in December to try to review it. I'll make sure I get that out to you as early as possible so you have a chance to see the changes. And when you do that, if you see something that you think needs to be changed, let me know, because we can certainly make those prior to the meeting. Okay.
Okay. That's all I had.
Okay, I do want to go to the district's version of this document, because, I mean, a lot of the information we have is identical to what they have, so I'm not going to spend a whole lot of time on it. But at the end, and this is the same, very similar charts that come from our system where we're tracking it. But at the end, I tag on the sales tax report, and I always bring this to you. So this is dated as of September 30th. I was hoping we get tax revenue, the sales tax revenues in before the meeting, before yesterday, and I couldn't see it yet. So it probably showed up today. But as of yesterday, so this is through September 30th, we received $214 million for sales tax. So we're at 112% of the projection right now. And when I'm at the ISOC meeting, the Sales Tax Oversight Committee, and some of you are on that, I always remind them, don't get excited about that number yet. It's a 10-year tax. Things will change. And Mr. Elmore's chuckling because I do say it at every single meeting. Don't get too excited yet. It's 10-year tax, but it's something we're monitoring every month. We're looking at that. Expenditures to date, $59 million. We also have $48 million in contracts issued, so these numbers are going up. And I gave you more. Usually I only show you the breakout for the last quarter, but I just wanted you to see what happened over the summer. I mean, monthly expenditures were about between 2 and 4 million. It jumped up to 7.5. July is negative because anything done in June we have to accrue back. So those bills we haven't received all the bills, and normally work done in June, the bills come in July. We have to accrue it. So July almost always is negative just because the work for July is billed in August. So the June number looks twice as big as it should, and then July goes slightly negative, but then it bumps up to 5 and 9 million. There was a lot of work done over the summer, which is what was promised, and so those numbers are coming in. So that's the expenditures, and then we have not done any borrowing yet for the sales tax, and we will need to do something this year. And what we're looking at, and we talked about this at the last meeting, I believe, we're looking at a short-term solution, either a commercial paper program like we did last time or some type of line of credit. I need to have something in place before the end of the year because I have to have that in order to budget the numbers. So even if I have extra cash, I have to have it in order to budget for it. It's a state law. So I'll have to at least have something available even if I haven't drawn on it by the end of the year. So we'll be bringing that back to you probably in February. So there's no interest owed, but we have earned $2.4 million of interest earnings. So I'm working on trying to figure out a way to borrow, and if we can do something like we did last time where we were able to keep the positive arbitrage, I want to do that. So I'm working, trying to figure that out with the facilities folks because a lot of it depends on how quickly they can spend the money. But this is the sales tax report. Everything's, the revenues are coming in better than we expected, and that's good. So all is well there. Any questions on anything related to investment? We spent a lot of time on this today, partially because there's not really anything on the debt side to talk about, which is why we don't have an audience today. It's also the annual report, so I wanted to make sure we spent a little more time on this and got into a little bit of the weeds. So this was 2 quarters plus an annual report on investments. So before I leave this, and I do have one small debt issue we need to talk about, so I want to make sure there's any questions. Okay, so on the debt side, it's 2 slides. We did the TAN sale. And we had all the students here. It was a great day, and this is the result of the TAN sale. The winner was Morgan Stanley with a bid of 1.99. So the total net interest cost, I think, is just, actually, I think it's just over 2 when you add in cost of issuance. And we're expecting the investment, once the money comes in, to be investing it at 2.8. I'm waiting to see how that happens in December. That Fed increase may or may not change that rate. And we'd be investing it probably early December and locking in the rate till August 28th. I always do it 2 days prior to the date this is due, so I make sure I have the cash to be able to pay off the note. So we'll be investing that sometime in December, most likely.
Did all the members of our so-called management team participate?
I send notes out to all of them, and it usually helps that they're here with the students, and they want to make sure they've submitted a bid. So one of the, the reason we have the students come in for the TAN sale is it's an educational benefit to the kids. But the side benefit is all those bankers in the room, and they don't want to be embarrassed if there's not a bid. So we usually get really good bids from the firms. We compared to Broward. They priced a week before us, and they priced a little bit better because their note was shorter. They have theirs mature in June, where ours is in August. So that made a difference. That was really the big increase. But we always compare and look to see what everybody else got to make sure we have a slightly better credit rating. For long term, for short term, it's exactly the same. So in theory, they should be about the same, but they were 2 months shorter than we are, so they got a better
My
rating.
question was, do all
They do.
in the current management team participate?
Yes. Yes. And that's one of the things we look for to make sure they're all there. I will tell you, Stiefel Nicholas, they bid, the 2 bankers that we work for from Stiefel Nicholas just notified me they moved to another firm last week. They moved to Hilltop Securities, so I'm trying to reach out to Stiefel Nicholas to find out who the new contacts are there. Because the 2 bankers we worked with regularly are no longer there. So it's something I'm working on behind the scenes. The other thing we did was that equipment lease we talked about. So this was borrowing money to purchase and install chillers, or the main component of the air conditioning systems at 41 schools. And you've probably seen in the paper we've had some issues with air conditioning. This is going to solve a lot of those issues. So $16 million to make a lot of improvements at 41 schools. The true interest cost on that is just above 3%. So that's in place. It closed last week. And with that, I think the only other thing we need to do is the election of a chair and vice chair. But before I do that, is there any questions regarding the TAN or the equipment lease? Okay, so every year you're required to elect a chair or vice chair. It's supposed to be the first meeting after the start of school. So this is the first time we've met. So I would ask for nominations for a chair for the committee.
I nominate Rick Miller to continue in his role.
Okay. Second? All in favor?
Aye.
Okay, good. So vice chair. I think Dr. McDaniel is the current vice chair, but,
Nominate.
Self-nominate.
Well, I
Okay.
nominate you. You don't have to do
okay, is there a second?
Second.
Okay, all in favor?
Aye.
We're done. Okay, great. Thank you very much. And the next meeting, it is Friday, and I think I have the date right. It may be the 12th. Let me see. It's on the back of your committee. It's the 14th. I just looked at that and said, that doesn't look right. It's December 14th is the next meeting. And remember, that is the one where we bring in breakfast as a thank you to you all. So don't eat before you come here. There'll be bacon and eggs
September is
and
the
the whole
Christmas.
shebang. And then we have lots of discussion about policies and things that we'll be talking about over the next year. It is the 14th. This is not correct.
Oh, 14.
It's the 14th. So
14th,
if you look at your agenda, which you have a hard copy of, the second page of your agenda has all the dates going back through 2019. So you can load all those on your calendar. And I don't think I've sent calendar items out for 2019 yet. I'll make sure I get that done quickly. And I've already got the proposed items, what I think we'll be talking about at each meeting.
Back to that page.
Oh, back to this
Okay.
page.
Yep. So I don't have anything else. I think we're
Well, thank you.
Well, enjoy it. Thank you very much.
thank you.
Terrific, really.
Good.
Great report.
It's a good meeting, and
So
we're
with
done
that,
early.
we're adjourned unless we have any other
Very
business.
good.
Thank you all again. I really appreciate your time, and we will see you in December.
Okay, so how you doing?
I'm,
Well, I guess in your concerns